Woolworths posted the kind of quarterly numbers that should have lifted its share price. Group sales of $18.1 billion, up 4.5% on the prior year. Australian food revenue up 5.9%. E-commerce surging 20.2% to $2.7 billion. Customer satisfaction scores rising, loyalty membership at a record 10.7 million. And the stock fell 10% in a single session. That is not a minor disconnect. A 10% drop wiped more than $2 billion from Woolworths' market capitalization. It made the stock one of the worst performers on the ASX 200 that day, on a day when the broader index itself was already under pressure. The surface-level explanation is that management revised earnings guidance. Australian food EBIT growth, previously tracking toward the upper end of the mid to high single-digit range, would now land somewhere in the middle. New Zealand operations, already under pressure, flagged second-half EBIT below the prior year. Those are real downgrades. But the scale of the sell-off relative to the guidance change deserves scrutiny. Morgan's, one of the brokers covering the stock, trimmed its underlying EBIT forecast by just 1% across FY26 to FY28, and then upgraded its rating from hold to accumulate. Bell Potter went the other direction, cutting its price target and downgrading to hold, but the earnings revision there was 4% for FY26, 10% for FY27. Neither broker's numbers justify a 10% single-day decline on their own. What the market was pricing was not the guidance miss itself. It was what the guidance miss signals about the structural environment these businesses are operating in.
The cost pressure hitting Woolworths and Coles is not a company-specific problem. It is an external shock arriving through a very specific channel, oil prices tied to the Middle East conflict. Brent crude briefly spiked to $126 a barrel during the week of these results, before retreating to around $11. That is not a normal input cost environment for grocery logistics. Fuel flows through supermarket economics in multiple places simultaneously: delivery to distribution size, last-mile fulfillment for e-commerce, refrigeration costs, packaging made from petrochemicals. Coles made this explicit in its own third-quarter update, which arrived the following day. Sales grew 3.6%, comparable to $9.8 billion, with e-commerce up 24.8%. Volume-led growth, inflation moderating to 0.8%, excluding tobacco. Healthy numbers by any measure. But the company's outlook statement flagged an increase in supplier cost price increase requests and higher costs within our own operations, particularly in fuel, freight, and packaging. The phrase supplier cost price increase requests is the one that matters most for margin trajectory. When suppliers face their own input cost inflation, they push for price increases at the wholesale level. Supermarkets then face a three-way choice: absorb those increases and compress margins, pass them to consumers and risk volume loss, or negotiate harder and risk supply disruption. Both Woolworths and Coles are signaling the intent to absorb a portion of those costs, at least in the near term, rather than fully pass them through. That is a competitive positioning decision, driven by ongoing public and regulatory scrutiny around supermarket pricing, which brings the discussion to something most commentary on this week's numbers has underweighted. While Woolworths' quarterly results were being digested by markets, a federal court trial was entering its second week. The Australian Competition and Consumer Commission has accused Woolworths of disguising price increases by temporarily inflating shelf prices, then advertising the rollback as a discount under its Prices Dropped promotion. The specific example before the court, a 2-kilogram pack of Fab laundry powder that sold at $7 for over 400 days, was then raised to $14 for just 19 days, before being repriced at $8 and marketed as a discount. Woolworth's own commercial pricing manager acknowledged under cross-examination that the company had broken its internal rules for the minimum price establishment period required before a product could enter the Prices Dropped program. He further acknowledged that $14 was never intended to be a lasting price point, and that the price increase was set up specifically to enable the subsequent promotional framing. This is not peripheral context. It directly constrains what management can do in response to the current cost environment. Both Woolworths and Coles are now operating under intense regulatory and reputational pressure on pricing conduct during a period when their input costs are rising sharply. The normal playbook, push costs through to the shelf, dress it up with promotional mechanics, is under active legal challenge. The decision to absorb fuel and freight costs rather than immediately pass them through is not purely altruistic. It reflects the litigation risk of being seen to inflate prices during a cost of living crisis, while simultaneously defending against ACCC allegations of fake discounting. The margin squeeze is partly self-imposed and for structurally sound reasons. The trajectory from here splits along a single variable: how long the Middle East disruption persists. Bell Potter made this explicit in its downgrade note. The broker expects the margin impact from supply chain inflation to amplify through the fourth quarter of FY26 and carry into FY27 as a run rate. Its FY27 earnings estimate was cut by 10%. The key condition attached: outcomes are dependent on an easing in Middle East tensions. That is the convergence point for everything: fuel costs, freight costs, supplier price requests, and the consumer spending environment. If oil prices remain elevated through the second half of 2026, the downside path becomes a multi-quarter margin compression story. Both Woolworths and Kohl's would face the fourth quarter of FY26 with cost run rates already baked in, limited ability to pass through price increases without regulatory exposure, and consumers becoming more cautious. Woolworths has already noted signs of increased customer caution and pantry stocking behavior in March, the latter being a demand pull forward, not sustainable volume. The recovery path, however, is not speculative. Woolworths' volume growth, excluding tobacco, ran at 7.3% in Australian food this quarter. That is genuine market share capture, not inflation-driven revenue inflation. Customer satisfaction improved. Loyalty program engagement is at record levels. These are structural gains that persist regardless of the macro environment. Morgan's position, upgrading to accumulate with a 12-month total return forecast, rests on the view that absorbing costs now is the right long-term positioning. If oil eases, the cost headwind reverses while volume gains stay. The e-commerce build-out at both chains, now representing 16.6% of Woolworths' Australian food sales and 13.6% at Kohl's, continues to scale regardless of fuel prices. And Kohl's investment in automated distribution centers has already delivered margin improvement through efficiency. That infrastructure advantage does not disappear because spot fuel prices are elevated. The less discussed upside case for Woolworths specifically, a resolution of the ACCC trial or even a negotiated outcome, would remove the single largest constraint on its pricing toolkit. The company cannot freely use promotional mechanics while that litigation is live. A cleared legal position would restore optionality that the market is not currently pricing. Evidence points toward continued near-term margin pressure for both stocks, but only if the oil disruption is sustained well into the second half of 2026. The structural operating trends, volume growth, digital penetration, loyalty scale, point in the opposite direction once the external cost environment stabilizes.